Inflation. Everyone's concerned about it. Now, I know the government's saying inflation's down to about 3%, but you know what? We don't feel like it is because it's 3% on top of the big increase of 8.5% just 18 months ago. So, you know, prices aren't coming down. They're still very, very high, and we all feel that, I think. Inflation is really the silent killer of retirement income, and it's one of the top risks you really need to address. Now, when I talked about this 3 or 4 years ago, it was hard to, I'll be honest, it was hard to get a lot of traction from people to be concerned about inflation because inflation was 1.5% to 2%. But even with low inflation, it slowly erodes your income. It's like the cholesterol of retirement. It sneaks up on you, and then you wake up one day and you're like, what in the world happened? You don't feel the immediate effect like you do if you lose a lot of money in the stock market, but it sneaks up on you. And that's why I call it the silent killer. Now, what about in today's world? What do we need to be thinking about moving forward? Number one, I think we need to not overreact. Yes, prices have been set higher. We're not going to, in my opinion, average 5 or 6% inflation over the next 20 or 30 years in your retirement or whenever you retire. In our entire history, inflation has averaged a little less than 3%, but that includes that one period of time in the 70s when it was just crazy in double digits. And if I take that out, inflation's averaged about 2.5%. So now it's higher than that right now. Will it get back to 2% the Fed wants? We don't know. Bottom line is it erodes your income. The problem is, and I get asked all the time, Jim, what's the best way to invest my money to beat inflation? I get that, should I put it in gold? Should I put it in resources? Should I put it in other types of commodities? Should I put it in other real assets? What should I do? And yeah, in short periods of time, there are certain things that sometimes perform well as an inflation hedge, but they don't always perform well as an inflation hedge. The bottom line is, over the long term, if you're looking at your entire retirement in the years, if you're not already retired, leading up, and then your full retirement, the number one way historically to beat inflation with your investments is the stock market. But what's the problem with the stock market? It's completely unpredictable in the short term, and it's volatile. We can't depend on anything in the short term. So if we want income, we don't want to be depending on the stock market this year to provide us with our retirement income because we don't know where the market will be. And if we're, later this year, if we're having to spend money from the stock market, inevitably it will be down. And that means we'll have to spend it when it's down and we'll compound our loss. The money will never, ever come back. So we have a dilemma. The best way to beat inflation with our money is having at-risk market investments, but it's completely unpredictable in the short term. So I think the key is to segment your monies. And the money that you're going to need to draw income for in the next 5 to 7 years has got to be, in my opinion, in things that are more stable or even protected. Treasuries, CDs, that kind of stuff. Now, they're paying good rates right now, but historically, CD rates, and they do from time to time, but CD rates over time do not beat inflation. So see, we don't want to put too much money in those kinds of things because over time they're not going to beat inflation. But they give us predictability of income. Then the money we have at risk, that's our long-term protection against inflation. But we can't be depending on it in the next 6 or 7 years. So we're going to set it aside and leave it alone to grow through inevitable ups and downs. Now, if I need to depend on it in 6 and 7 years, I can't take too much risk. I can't take the same kind of stock market risk I took when I was 35 if I'm going to need this at-risk money in 6 or 7 years. So it still has to be extremely diversified, and you do have to have some hedging in there to protect you from the really big downturns in the stock market. But I think you've got to segment your money that way because longer term in retirement, inflation is just as big of a risk as losing money in the market. But the market's the best way to beat inflation long term. So you have to balance that and create an income plan that can mitigate the reality of short-term market volatility.